Welcome to Statement of Cash Flows, Skeleton. By the end of this ACLET, you should be able to prepare the skeleton of a statement of cash flows. The easiest way to prepare a statement of cash flows is to start by blocking out the major sections of the statement. In this ACLET, we'll refer to this as the skeleton of the statement. First, the usual 3-line heading, which includes the company name, report title, statement of cash flows, and the date. Which form of the date is applicable here? The short form, which shows just the last day of the accounting period, or the long form, which shows the entire accounting period? We need the long form because the statement will show all the cash that came in and went out during the entire accounting period. Then we will set up a section for each of the 3 cash flow categories: operating, investing, and financing. The title for each of these sections will be consistent: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. The last line for each section is also consistent: net cash flows from operating activities, net cash flows from investing activities, and net cash flows from financing activities. We will use 2 number columns, the first for details, the second for subtotals and totals. We'll enter some items in our partially complete skeleton to give you an idea of how the number columns will be used. In another ACLET, we'll actually prepare a statement of cash flows. The detail amounts are entered in column 1, making sure that cash inflow amounts are positives and cash outflow amounts are negatives. Then, for each section, we calculate the total, again making sure that if cash inflows exceeded cash outflows, the total is positive. And if cash outflows exceeded cash inflows, the total is negative. What would be the next logical step? To add the totals for the 3 sections, right? Again, making sure to pay attention to whether the result is positive or negative. In our example, the result is negative $17,000. Now we need a label for this total. Think about this. Remember that every penny of cash that came into the company and that went out of the company during the accounting period has to be in one of the 3 sections. Since we've included all of the changes in cash, the total of the 3 sections is the total change in cash. This is called the net increase or decrease in cash. The parentheses around the word decrease tell the reader that if the corresponding amount is negative, it indicates that cash has decreased by the end of the accounting period. And if the amount is positive, it indicates that cash has increased. Next, we need to prove that we have, in fact, accounted for every penny of cash that came in or went out during the accounting period. So we take the increase or decrease and add it to our beginning cash balance. Remember that when you add a negative, it's the same as subtracting. The result should be our ending cash balance. Beginning cash plus the increase or minus the decrease equals ending cash. We will compare our calculated ending cash balance to the cash balance on the balance sheet. If the 2 numbers agree, we have proven that we have accounted for every penny of cash that came in or went out. The next section of the statement of cash flows is called Schedule of Non-Cash Investing and Financing Activities. You might wonder why we would have a section for non-cash items on a statement of cash flows. FASB added this section because sometimes companies enter into significant transactions that don't affect cash. If cash is not affected, the transaction will not be included in any of the 3 main sections above. But FASB thought that readers of the statement should be aware of these significant transactions. The schedule of non-cash investing and financing activities is different from any other section on any financial statement. You will not need a number column for this section. Instead, you'll write a brief description of the transaction, like a short story. For example, say that a company exchanged 80,000 shares of its own common stock for a building worth $400,000. You might make an entry in the schedule that says, acquired a building valued at $400,000 in exchange for 80,000 shares of our common stock. Recall that issuing shares of our own stock would be a financing activity, and acquiring a building would be an investing activity. But since no cash changed hands, this is a non-cash investing or financing activity. The last section of the direct method statement of cash flows is called reconciliation of net income to cash flows from operating activities. We'll use just one number column for this section. More information about this section is included in a separate ACLET. This concludes the ACLET Statement of Cash Flows skeleton.